Welcome to the Explainer. Okay, let's dive right into this. If you've been paying any attention to the explosive growth in the AI hardware supply chain, you already know that actually making the chips is only half the battle. Making sure those incredibly complex next-generation chips actually work, well, that's where the real bottleneck lies. And that is exactly where Onto Innovation comes in. Right now, they are a critical and arguably indispensable player in the market. Here's a quick roadmap for today. We're going to hit the Q1 2026 earnings breakdown, check out the AI technology engine, look at strategic partnerships and R&D, dive into valuations and market risks, and finally, we'll compare them to the competitors. Let's kick things off with Section 1, the Q1 2026 earnings breakdown. Boom. $291.9 million. That is Onto's record-breaking first quarter revenue for 2026. And look, this isn't just a big number in a vacuum. It represents a solid 9.5% increase year over year. In a highly competitive semiconductor landscape where capital expenditure can be super lumpy and unpredictable, putting up a record revenue figure like this, that's a massive signal to the market that demand for their specific equipment is absolutely surging. And this brilliantly illustrates that it's not just about top-line growth, right? It's about operational efficiency. They delivered an adjusted earnings per share of $1.42, which nicely beat analyst expectations of $1.38. Plus, their non-GAAP gross margin actually ticked up to 55.7%, improving from 55.1% in the first quarter of last year. This tells us they are managing their costs effectively even while scaling up. And if you check out their revenue guidance for Q2, it's a very robust $320 to $330 million. That signals this demand isn't just a one-off blip, it's sustained. Moving right along to Section 2, the AI technology engine. You'll hear terms like metrology and macro defect inspection thrown around a lot in the semiconductor space. But let's define this simply. Think of Onto as the ultimate quality control for the world's most advanced technology. They literally build the tools that perform highly precise measurements and detect microscopic flaws on silicon wafers. When you're manufacturing incredibly complex, advanced AI chips, even a microscopic flaw can cause the entire chip to fail. So Onto's systems ensure that chip makers aren't throwing away millions of dollars on defective hardware. Like I said, indispensable. Now, what's really interesting here is how Onto splits its focus to cover the two most critical avenues of next-generation chip making. First, you have the Dragonfly G5 system. This is the absolute star of the AI show, built specifically for advanced AI packaging, heterogeneous integration, and high-bandwidth memory, or HBM. This is the stuff that goes into the massive AI accelerators everyone is buying right now. Then you have the Atlas G6 system. This one is focused on the actual transistor architecture. We're talking gate-all-around metrology, advanced logic, and next-gen DRAM. Basically, they're covering both the advanced packaging and the advanced architecture. And the market? Well, they're buying in heavily. Onto just secured a massive $240 million volume agreement with an HBM customer that runs straight through 2027. And within that, over $60 million is earmarked specifically for their 3D metrology systems. Because of this whole AI infrastructure boom, demand for that Dragonfly platform we just talked about is expected to surge by more than 50% in 2026 compared to last year. Meanwhile, the Atlas G6 is no slouch either, driving an expected 25% revenue growth in advanced nodes. These are the very engines pulling that financial train we saw in Section 1. Which brings us to Section 3, strategic partnerships and R&D. When we look at their R&D spending trend over the trailing 12 months, it's been remarkably consistent, hovering right around $35 to $36 million per quarter. In fact, that $35.1 million figure for Q1 2026 represents a 25.2% increase year over year. They are pouring millions right back into future innovation. They know the transition to even more complex 2.5D and 3D logic architectures simply won't wait for anyone, so they're fully funding the research to stay ahead of the curve. But they aren't just building from within, they're partnering strategically too. A major highlight of their recent quarter was an expanded collaboration with Rigaku Holdings. This involves a substantial minority stake investment specifically tied to next-generation X-ray solutions. Onto is already a leader in optical inspection, right? But by integrating advanced X-ray technologies, they're essentially widening their technological moat, ensuring they can solve the absolute most complex multi-layered semiconductor challenges that optical light just can't penetrate. So we've got record revenues, explosive AI-driven product growth, and aggressive R&D. It sounds like a flawless story, right? But as focused learners of the market, we have to ask the hard question here.
Is Onto innovation priced for perfection? Have all these incredible fundamentals already been fully baked into the stock price, leaving absolutely no room for error? Let's unpack that in Section 4, Valuations and Market Risks.
So the crucial point is that there's a massive tug of war going on right now. The bull case points out that with shares trading around $277, it's actually slightly undervalued compared to analyst fair value estimates of $280.71. And that's almost entirely because of that massive AI packaging runway we discussed. But you've got to look at the bear case. The stock is trading at a staggering 129.6 times earnings. For context, the US semiconductor industry average is only 64.8. You are literally paying double the industry premium. Now, the stock has immense momentum. It's up over 182% in the past year, but it is highly exposed to macro risks. Whether it's the extension of US export controls limiting business in China or just ongoing tariff uncertainties, any geopolitical friction could really disrupt their supply chain or customer demand. Now, we aren't taking a stance on these policies, but purely from an analytical perspective, these variables introduce real, tangible risk to a stock priced at 129 times earnings.
Finally, let's wrap up with Section 5, Comparing the Competitors. Because Onto absolutely isn't the only company riding this wave. Take KLA Corporation, an absolute titan in semiconductor process control. In their recent outlook, they stated exactly what we've been discussing. As process control becomes increasingly critical, the company believes it can continue outpacing broader wafer equipment market growth. The rising tide of AI and complex architecture is essentially lifting all the boats in the metrology and inspection sector. Let's move to the metrics and see how this builds a comparative picture. Looking at them side by side, Onto is a high-flying $13.5 billion company, but KLA, they are a $235.8 billion behemoth. And look at the margins. Onto runs at a 10.3% net profit margin, while KLA's massive scale allows them to operate at an incredible 35.7%. And then there's that valuation gap again. You are paying over 126 times earnings for Onto's pure-play, rapid-growth AI story, whereas you can buy KLA with its vastly superior margins and global scale at just 51 times earnings. Plus, you even pick up a small dividend while you wait. Which leaves us with the ultimate decision for anyone analyzing this space. You've seen the record revenues, the indispensable tech like the Dragonfly G5, and that massive R&D push. But you've also seen the dizzying 129x earnings multiple and the macro risks hovering on the horizon. So I'll leave you with this. With the AI hardware race accelerating faster every single day, do you pay the heavy premium for Onto's explosive, pure-play growth story? Or does the margin dominance and sheer scale of established giants like KLA offer a better, safer route? It's a fascinating puzzle, and one I highly encourage you to dig into further. Thanks so much for joining me on The Explainer today, and keep learning.